We're going to keep things simple. We thought it's a good time to review what's happened in the first half of this year before we take a look at what's going to happen in the second half. So Hunting is going to be covering the ASEAN, and I'll be looking at the exchange rate markets. So without much ado, over to you, Hunting.
Thank you, Philip. So we have quite a lot of cover today. And before we start, I think if you have any questions, you can kindly scan the QR code that we have here, or head to dbs.pigeonhole.at and enter the passcode macro, and we'll be glad to answer any of the questions that you have regarding the topics that we are discussing today at the end of our sharing. So without ado, let me go straight into what has evolved for Asia, for ASEAN, and globally in the first half of 2025. So first of all, I think since Trump won the US presidential elections in November, we knew that it was going to be quite a more protectionist era under Trump. But I think the scope and scale of what has happened has really shocked us. So it has been quite a tariff chaos under Trump 2.0 in the first half of 2025. And if we were to go by what we are seeing in the global trade policy uncertainty index on the right chart, it has really spiked up over the past few months and reached a quite multi-year high in April. That has subsequently eased off with some de-escalation in trade tensions, but is still looking quite elevated and probably will be remaining quite elevated for the coming few months. And if we go by the tariff announcements that we have seen in the past few months, the US tariff rate would rise to what we have not seen in many decades. And I think for Asia and ASEAN, this would be quite a negative development. Now, the markets were bracing themselves for the Liberation Day in April, but what was announced came as a massive shock, as the tariff rates that were being announced were not really exactly reciprocal per se. The Trump administration released a formula on how they calculated the reciprocal tariff rates, and it basically reflected the number that the US would want to impose to try to reduce the imbalances that they have with their key trading partners. And therefore, I think the rates reflect the amount of trade imbalances that the US have with the Asia and ASEAN trading partners, with China therefore taking quite a high rate, and the ASEAN countries reflecting also quite high rates. Now my next slide here, I show the tariff rates and exposure to the US market that with the rates that was being announced on Liberation Day. So we can see that on Liberation Day, Vietnam was being hit the highest at 46%. And if you've seen from the last chart, actually the imbalance that Vietnam has with the US is actually the third largest for the US. And therefore, I think the reciprocal tariff rate that's being hit has been quite high. And without a doubt, I think with Vietnam's very high exposure to the US markets in terms of its goods exports at nearly 30%, that is causing some fears for the Vietnamese. And we can see in this chart that secondly, Thailand was also being hit by very high tariff rates on Liberation Day at 36%, with its exposure to the US market at around 18%. Singapore is perhaps one of the lowest exposed to the US market, as the US actually runs a goods trade surplus with Singapore, but nevertheless, it was being hit by a 10% baseline rate. So what we have seen then was a period of uncertainty, and subsequently, I think on April 9, what we have seen is that the US administration embarked on this de-escalation through the 90-day tariff pause. And that seems to show signs how the Trump administration has escalated the tariffs to eventually try to negotiate and de-escalate. So here I also have a chart on the US tariff rates on Chinese goods under Trump 2.0, and what initially started to be small increments in the tariff rates due to non-trade issues eventually escalated in April. Eventually, I think in May, they decided to talk, given that I think the very high tariff rates at 145% doesn't do well for both sides. Eventually, during the 90-day pause, it landed at around 30%, and that would last to around August 12. So this de-escalation, the 90-day tariff pause, has seen exporters in the region try to front-load their orders. And this is quite clear in the chart that I show here, where the ASEAN 6 exports to the US really accelerated over the course of the first half, while that to the rest of the world is expanding at a more modest pace. And if we were to drill down into the key ASEAN 6 exporters, such as Singapore, Malaysia, Thailand, Vietnam, this is also quite evident in their exports to the US, in certain cases reaching 40%, for example, in the case of Malaysia in the April to May months. And I think that would bode quite well for the second quarter GDP results of these economies when they are eventually announced. The other driver of this front-loading has been electronics exports. I think during the course of this 90-day tariff pause, there was also exemptions on key products such as electronics and semiconductors. And with the fear that potential sectoral tariffs may come forth over the coming months, the exporters, front-loaded these electronics products with quite big increments in the electronics exports that you've seen in this chart. For example, Malaysia has done quite well, and in fact, US imports quite a lot of semiconductors from Malaysia, and Malaysia is the top market that the US imports from. So now, just now I talked a bit about the economic growth numbers. So certainly, I think when you look at the GDP numbers, the economic growth entered 2025 in quite decent shape. 2024 was a year of more upgrades than downgrades for the region, as it benefited from the electronics upswing. But I think pretty much with a firm first half and resilient first half, this has probably peaked, and second half would bring a slowdown. So the country that has first reported in the region is Vietnam, and here we can see from the black line that the real GDP growth numbers have been quite strong. In fact, in the second quarter, it came in at 8%, bringing the first half to around 7.5% year on year. So that's quite reflective of the exports front-loading that I've just discussed. And this similar dynamic would also fit into some of the key economies here. And for example, next Monday, Singapore will release its second quarter advanced GDP estimate. And here, due to this front loading, we are not expecting a technical recession. Basically, this front loading would allow the Singapore economy to avoid a technical recession in the second quarter. But if you look at the real GDP growth forecast that I've put here on in the table, you can see that the growth numbers will be weaker than that of 2024, and also perhaps weaker than that of what will be registered in the first half of 2025, suggesting that a second half slowdown would be quite likely for the various ASEAN economies. I would also like to point out for US, the tariffs are also not something that is good for the economy, given that it will probably translate into a stagflationary sort of impulse. So our house view there is for a slower growth at 1.5%. So below trend, but not recessionary. So I think the key questions on everyone's minds is what's next after the 90-day US tariff truce? And what has been announced so far? So over the 90 days, the US only managed to get 3 key deals or frameworks that are announced. Basically, UK, China, and Vietnam. Contrasting very drastically with the 90 deals that they wanted to do over the 90 days. And showing that how hard negotiations have been over the course of the 90 days with the US. So Vietnam is the first one that's been announced in the ASEAN region. And I'll go into more details in the subsequent slide. Now let us shift the attention to what has been announced over the past week. And the first tranche of tariff letters have been sent out to the US, and it's a bit of a mini liberation day in that the tariffs have returned to the steep levels. If you can see here from the table that I've shown, Thailand is back to 36, Indonesia 32, Malaysia, Japan, Korea at 25, with Malaysia being slightly higher. But you also see declines for certain economies like Laos, Myanmar, Cambodia. We'll probably see a couple of more letters being sent out to the ASEAN region, and we'll be anticipating that for Singapore, Philippines, which have not received their letters just yet. Here I also mapped again some of the exposures for the various economies that have either received their letter or not in the region. And we can see that the countries that seen some of the decrease in the tariff rates are also that are exposed to the US, probably because I think places like Cambodia, Vietnam, which had a deal, sent these footwear, garments, textiles that will eventually have a price shock to the US consumers. So there's some effort to try to mitigate the price shock there. Beyond that, which countries are still quite exposed? I think Thailand, Malaysia would be some of the economies that are more exposed to the tariff shock, whereas the one that are going to see more limited impact would be places like Indonesia, Philippines, or even India, which I didn't list here, which exports to the US account for just around 2% of their nominal GDP. So the newly announced US tariffs are scheduled to be effective starting August 1st. And we can see 3 things that we can glean from the tariff letters. First, in the tariff letter, they said that this will be separate from all sectorial tariffs. Secondly, I think there is mention of that goods transshipped to evade a higher tariff would be subject to that higher rate. And I think implicitly, this is also referring to goods that is being rerouted through some of these economies to reach US, given that these economies had a lower tariff rate than China. Thirdly, like I mentioned, the new US tariffs will be scheduled effective as of August 1st. So essentially extending the reciprocal tariff deadline from 9 July to August 1st. And this means there's a short window of period of about 3 weeks for countries to continue negotiating with the US. So Vietnam is one of the countries that had announced framework or deal with the US. And here I try to map out what has happened. So on Liberation Day, it was threatened with 46%, and over the course of the 90-day pause, it had tariff of 10% that resulted in so much front-loading across the various goods. So with the trade deal, the new tariffs that will come in place would be 20%. So increasing from the 90-day pause rate, but much lower, less than half than 46%. So that's better than initially feared. But the caveat here is that this will be a tiered tariff rate in that 40% would apply for transshipped goods. But it remains unclear what exactly is meant by transshipped goods, and a wide range of estimates hold with regards to goods that are rerouted through Vietnam. So I think Peter Navarro, the trade advisor for the US in April, said around 30% of those headed to the US were rerouted. But an economic study by Harvard provided estimates of around 2% or so to around 16.5% that's rerouted to the US. So I think the definition can vary a lot, and it really depends on what are the details that the two sides are still negotiating on and will eventually ink in the coming weeks. So ultimately, Vietnam has probably avoided the worst, but it would still face a 20% rate that will be higher than pre-Trump 2.0. So in these various categories like electronics, textile garments, wooden products, we'll probably still see some slowdown in the second half in terms of the exports performance, but not as much if the tariff were to be at 46%. In the next few weeks, I think there will be a dash for further US engagements. And here I list down the 3 countries that have received their letters and their response and reaction to what was being announced. I think pretty much what is being consistent throughout Thailand, Indonesia, Malaysia is that this came as quite unexpected, given that countries like Malaysia has been probably earlier in the negotiations. Indonesia has also been negotiating, and Thailand has been late in the game, but I think pushing their proposals in the last couple of weeks. So these few countries will continue to try to negotiate with the US to try to bring down the tariff rates from very high levels. And I think there are some common factors that are going on in their negotiations, which is in terms of buying more US products or making their market more accessible to the US. And lastly, I think tackling some of the transshipment issues that also surfaced in the Vietnam deal. So I think these are some of the issues that the region would try to do to try to reduce the tariff rates and avoid the worst. Yesterday, we heard more about sectoral tariffs, and these threats are getting underway. I think for some time, the news has not talked about sectoral tariffs, and we thought that Trump has forgotten about it. But in fact, not. The 232 investigations have largely completed, and now Trump has threatened in terms of the sectoral tariffs. And here 3 things are being mentioned: 50% on copper, up to 200% for pharma, but may come at least a year later, and semiconductors being studied in the pipeline. So we have studied the exposure of Southeast Asia on these various sectors. And at least for copper, Southeast Asia is not a place that the US imports a lot from. US, in fact, import more copper from the countries like Chile, Peru, Canada. So in that regard, Southeast Asia is less exposed on copper. But where is more concerning would be in terms of US semiconductor exposure. And here, Malaysia is really at risk. And if you were to recall, during the COVID-19 pandemic, there was this huge disruption to the auto supply chain in the US due to the movement control in Malaysia. And I think this sort of reflects the risk to Malaysia's semiconductor exports. Other parts of the region, Thailand, Vietnam, would also face some risk as well. In terms of pharmaceutical exposure, in this table, you can see that Singapore really stands out, flashing red. But we know that and understand that Singapore has been engaging with the US. It is probably unlikely able to reduce its baseline US tariff rate below 10%, which is likely going to be the baseline that the US applies. But Singapore is seeking concessions on pharmaceutical tariffs. And if negotiation goes well, that would be a relief to Singapore. To sum up about the second half outlook, I think is really captured in this PMI chart that we see here, where factory sentiment remains quite weak. While exports have done well, manufacturers in the region has been very cautious and pessimistic about the outlook. And eventually, I think with tariffs possibly putting at still quite high rates compared to the past, and this big uncertainty that is going on, and coupled with the front loading that has taken place with the build out in US inventories, there could be a payback in the second half. So exports growth in Southeast Asia will probably catch down to the weak factory sentiment where PMI is in contraction below 50. So watch out for potential deceleration in the regional exports that would sort of bring growth down in the second half. Turning to inflation, I think inflation regionally has been quite contained. After the shock that we have seen in 2022, it has come down to quite manageable levels that are within target. And I think the region is quite exposed to commodity prices. And I think we've seen quite some volatility recently in terms of oil prices from an unstable Middle East. But so far, I think things have come down and oil prices are still quite contained. Food prices are also looking well behaved. And I think that would keep regional inflation contained in the second half of 2025. And what does this leave for monetary policy? We think that there will be looser monetary policy in the second half of this year. In fact, just an hour ago, Bank Negara Malaysia decided to cut its overnight policy rate for the first time in 5 years by 25 basis points to 2.75%. And in that, it highlighted downside risks to the growth outlook from external developments and uncertainties, including tariffs. And it said that it is being preemptive in its easing. And I think from what we discussed just now, there's also quite a lot of downside risk with respect to sectoral tariffs, especially semiconductors. So in Malaysia, I think probably there's still some room for rate cuts, given that they have also been lagging behind the easing cycle in the region. Indonesia, Philippines, Thailand has all cut, and there might be some room for further interest rate cuts in the coming months. The US, we have in our forecast put in 2 rate cuts, and if that were to take place, that will also aid the region in its rate cuts. The other thing that will probably be in consideration for the region is also the currency performance, which Philip would talk more in detail, but just a brief snapshot is that the ASEAN currencies have done quite decently, appreciating for Malaysian ringgit, Singapore dollar, Thai baht, Vietnamese dong weakening slightly due to tariff concerns, but by and large, giving some room for regional central banks to cut if they want to, because dollar weakness is not a concern. So let me wrap up with the key takeaways for Southeast Asia. And here we can see that the world faces a massive tariff shock amid the elevated trade policy uncertainty that's sparked by the US that's going to try to correct the trade imbalances and reshore investments. In the first half, what we have seen is that exports front-loading has supported the economies during the 90-day tariff pause, despite the trade escalation and some de-escalation. But our expectation is that regional economic growth in the second half is in stock, as the US tariff rates will probably be still quite high. Sentiment is weak, as we have seen from the manufacturing PMI, and trade policy uncertainties would still remain, especially in terms of sectoral tariffs. And therefore, I end you with a note that there's room for policy interest rate cuts in the second half. I now shall hand the time over to Philip, who shall bring you through our FX take.
Thanks very much, Hunting. Thanks very much, Hunting, for covering the ASEAN economies. I know it's not easy. It's been very challenging with Trump's keep changing his mind. Okay, I will now cover FX, but I think before I do that, if you have any questions, we already had some questions. I'm sure you have some for Hunting. Please, put them in the pigeonhole using this QR code here. Okay. Oops. Can we move? Yeah, I don't know. Yeah. Okay. Okay. I'm going to talk about FX. So, yes. Okay. So, let's start off by reviewing how FX has done in the first half of this year. We all know that the dollar index has plunged by more than 10%. That's really quite astounding, because we haven't seen this, I think, over the past few decades. So, but interestingly, let's dig a bit deeper and see how each block has performed. Okay, let's start out with the developed market currencies. Okay, so while DXY has dropped by about 10%, the real stars were really the European currencies, the euro and the Swiss. So in the DM currency space, what's quite interesting is that several currencies have decided to move along with each other. So naturally, the fastest has been the euro because it's the anti-dollar, and the Swiss has continued to be the king of havens. And on the medium pace, you have sterling, yen, and kiwi. So they are actually also doing quite well, about 8 to 9%. And here I use the term slowest Australia, Canada, but they are doing close to about 6%, which is roughly where the stronger Southeast Asian currencies are doing. Okay, so coming to Northeast Asia, I think the real story has been the Taiwan dollar. So in May, it surprised everyone with a 10% drop in 2 days. Okay, so that effectively brought everyone's attention to unhedged risk with regards to the weak dollar scenario, not just in the region, I think, but in also the rest of the world. So in a sense, the Taiwan dollar is the poster child, of hedging risk with regards to the weak dollar. Of course, the other surprise, has been the Hong Kong dollar's depreciation. I will talk about that more later. And so the two current countries that have been hit by Trump's recent tariffs, Japan and South Korea, for being too slow, or in terms of arriving at a trade deal. Interestingly, for this year, they have been highly correlated, and they have also been appreciating. I think partly also because they know that Trump has pointed out that these are among the Asian currencies that have been quite weak in recent years. Okay, coming to Southeast Asia, I think Southeast Asia is more of a mixed bag. Sing, Ringgit, and Baht, they're more or less led gains, but Sing continues to outperform in the region, primarily as a sort of haven. And Vietnam has been on sort of a depreciation path until recently because it was one of the hardest hit by the reciprocal tariffs announcements on April the 2nd. Okay, so but now that it has a deal, the rates aren't as high as what was originally announced. The depreciation sort of stabilized. IDR and Indian rupee has been more or less flat. Okay, but IDR has actually come back from its very weak level. So there's been, for those who have picked up the IDR in the past couple of months, it has been quite a profitable trade. And among, let's say, all these currencies, let's talk about the renminbi. Renminbi is actually pretty stable, despite all the big moves that we've seen in all the currencies. So, but I think in general, you can see that BRICS or BRICS-related currencies tend to be more stable. So India and China are BRIC members, so is Indonesia. So Malaysia, Thailand are partner countries. Vietnam just joined. Okay, so, but Malaysia and Thailand, has a history of being very sensitive to U.S. rate cut expectations. So they tend to do well, when rate cut bets are high. Okay, that's it. We had a very good move in the dollar sell-off in the first half. So looking into this month, we think that some of the conditions responsible for that have sort of weakened. Okay, so let's run them through one by one. I think the first obvious one is the waning U.S. exceptionalism narrative. Okay, so that has weakened after we've seen U.S. stock markets recovered back to record highs again. And end of this month, we're going to get advanced U.S. GDP. that's expected to rebound, according to the Atlanta Fed, to about 2 to 3%, which is pretty good compared to the negative growth that we saw in the first quarter because of the front loading of, to beat the tariffs. Okay, the second factor that the market has been focusing on was the Fed possibly cutting rates early in July. Well, that hopes have dashed after the stronger than expected U.S. job numbers last Thursday. Next week, we're going to get U.S. CPI, and tonight the FOMC minutes should remind everyone that the Fed is still looking for tariffs to lift inflation in the coming months. But then again, the Fed is also mindful that inflation expectations, especially the one by the New York Fed, has shown to be very stable over the 1 year, 3 year, and 5 year horizon. Okay, then let's go into the X date. Okay, so the X date, the fears of U.S. defaulting on its debt has gone after Trump signed the One Big Beautiful Bill on Independence Day, and along with that, they increased the debt ceiling by about $5 trillion. Okay, so, but this does not mean that the worst is over. Later, we will explain, that the One Big Beautiful Bill is also raising fears about one big unsustainable increase in the national debt. Okay, so, and next, the dollar weakness came on the back of relief from the trade tensions from the April 2nd Liberation Day tariffs. So that deadline has now been extended by the Trump letters to August the 1st from today. Okay, so okay, the interesting thing, I think not many people know that why August the 1st, because that comes after the July 31st hearing. Okay, so if you recall, the Court of International Trade actually put up a legal case, that Trump has exceeded his executive authority in wielding reciprocal tariffs. Okay, so if they rule negatively against Trump's tariffs, it could actually be positive. But then expect Trump to head to the Supreme Court to extend the case, and then we may also have another extension of this tariff deadline. Okay, and lastly, in recent weeks, the administration has also become quite uncomfortable with the market's fixation that the dollar was losing its mojo in the world economy. So primarily, I think officials have come out to talk down about U.S. losing its dominance. And we have also seen Trump coming out lately threatening an additional 10% tariff on countries that align with BRICS, what he called as anti-American policies. Okay, so how is the correction going to play out? Okay, I mentioned before that the DXY top two, beneficiaries has been the euro and the Swiss. Okay, so let's look at the DXY first. So at this moment, we think that the factors that we mentioned could see a correction or consolidation. So what we have mapped out is a potential price channel. So, and I've also put up a table on how high the dollar index can correct up to. And at the lower right-hand side, I also demonstrated that on an index basis, there's a huge correlation between the DXY and the euro and the Swiss. And I've also had, and I've used regression to sort of calculate the estimated correction levels based on the numbers that have come out for the DXY. So just put very simply, if the DXY goes to the midpoint, okay, that's around 98.2 to 98.6. I could bring the euro against US down to about just slightly below 115, and it could lift, dollar Swiss above the 80 cents again. So, but if let's say the global environment continues to be uncertain and continue, to lift the dollar as a haven, then we could see the dollar index. We can't rule it out, heading to a ceiling which is about 100 figure. So in this situation, then we think that euro could hit lower, to 113 or below, and Swiss, could possibly even, correct up further above 82, maybe even 83. Okay, but our big picture is still that, that's a correction, that, the fundamentals that's developing this year in Trump 2.0 is still pointing towards a weak dollar. So at the top chart, what I've done is I've shown you the half-yearly changes in the DXY. So this is the first time, as I mentioned before, in decades that we have seen such a big move. And what's interesting from this chart is that it continues to show a follow-through in the second half, but don't expect the same kind of, or the same magnitude of fall. And also, there's also this concern that, the weakness may also spill into next year. Okay, so why is that so? I think if you step back, this year Trump has been pushing three big policies agenda. The first, of course, is trade, where reciprocal tariffs has been key as a leverage, to force allies and rivals to accept unfavorable terms in trade talks. So we believe that this, will continue to fuel and not discourage de-dollarization. And second, as I mentioned before, they passed a one big beautiful bill, but market continues to be concerned about the unsustainable increase in the national debt. And the 30 bond yield is still rising, and every time it approaches the 5% handle, market, it sort of gives a signal that markets will become unwilling to fund this increase in the national debt. And later in the year, they'll be looking to ease regulation in the banks, primarily, to free up the limits for them to absorb, the bond issuance, mostly the long-term bonds. So you can see the link there now. Okay, so, and to do that, meanwhile, there's also the MAGA agenda that Trump is pursuing to encourage reshoring. And for this, I think we all know that, he thinks that the dollar is too high, and he thinks that US interest rates, are too high as well. So, and especially on the interest rate side, he has been pushing pretty hard to the point, that markets are alarmed, that the Fed's independence is being threatened. Okay, so let's start out with the most important currency in the DXY. Okay, the euro is the largest component, more than 50% weight. Okay, so that's why it's called anti-dollar, and that's why it has a high correlation with the DXY index. So we have seen euro, finally breaking above 112, back into the 115 to 120 range. So and it's quite astounding that euro's near 14% surge this year came despite the ECB's 100% basis points of rate cuts. So, and this sort of tells you that despite the widening in the differential in favor of the US, so it shows the market's inclination towards a weaker dollar. But more importantly, it's not just a dollar story. I think a very important event happened at the end of February following the Zelensky-Trump, White House meeting at the end of February. So that led, Europe to conclude that, the US peace dividend has ended and they need to take care of their own defenses and their own economy. So Germany, the biggest economy that has been struggling with a stagnant economy. I think the biggest impetus for the euros, the first impetus was the freeing of the debt brake. This is very important because this unlocked large-scale public investments, especially in defense and infrastructure, which is why the euro, when you look at how it tracks the stock indices, it's been tracking very closely the defense ETF stock index. Okay, then lately there's also ECB coming out and pushing a view that maybe the euro should take a bigger role or stronger role in the global stage, and that will help to strengthen the eurozone. So maybe this is also why the Trump administration has also started coming out to reinforce that the dollar is still the dominant currency in the world. But then again, let's not confuse dominance and the currency's direction, because ultimately in the end, policy does determine, and we, like I mentioned, we still feel that Trump still wants the dollar weaker and U.S. to cut interest rates, quite aggressively. Okay. Next, let's go to the renminbi. Okay, so renminbi is the other currency that has been brought up, by U.S. Treasury Secretary Scott Bessent. Says that no, renminbi can't replace the dollar, So, I mean, he's not convertible on the current account. Okay, but the renminbi is really a de-dollarization story. China has been fighting, U.S. treating it as a strategic competitor, So, and all this and the tensions that we've had since Trump 1.0. Okay, but I think what is important for me is that ever since China's new central bank governor came into office in 2023, we've noted, that the dollar China is behaving very differently. There are new behaviors in terms of how it's achieving basic stability. Okay, so essentially, in the past, the spot and the fixing tends to move together, around the center of the policy band. Okay, then ever since then, the spot has been allowed to fluctuate more in the upper half of the band. Okay, so, and during which we have seen China started, the central bank started to buy government bonds. So, and we have also seen how, especially recently, in recent months, how the renminbi has been quite resilient, still sticking in the upper half of the band, with the fixing still, within the 710, within the 710 region, in spite of U.S. tariffs going up from 20% to more than 100%. Okay, so, and right now, we've noted that the spot has converged with the fixing again, just like in the third quarter of last year, when the U.S., when the Fed was heading towards a 50 basis cut in September. So we'll be keeping a very close eye. Yes, the Fed's July cut has been dashed, okay, but the market is still holding out for a September cut. And the Fed is also watching all the conditions. Fed members are also becoming more divided, in terms of whether tariffs, will lead to inflation, and so increasingly the market is still looking for, the Fed to ultimately, deliver rate cuts. Okay, for us, we are looking for 125 basis cut over the next 4 quarters, starting hopefully in September as well. Okay, so when that happened, say like last year, what we've seen is dollar China, could move closer, towards the maybe 7 handle again, but below the 710 level. Okay, okay next. Let's talk about the Hong Kong dollar. Okay, so because Hong Kong dollar is very interesting this year, this is the first time ever that we've seen interventions at both ends of the convertibility band within a year. Okay, so why did this happen? Let's start out, with the Taiwan dollar appreciation that we mentioned. Okay, so that created a very weak dollar environment. So HKMA was defending the bottom of the at 775, the bottom of the band. So and to to push off the pressure, it flooded liquidity and brought the short-term rates, Hong Kong interest rates all the way down. So in doing that, it created a carry environment. So we all know that market like carry trades. So and after last year's aggressive unwinding in the Aussie yen, and this year BOJ is still hiking, but RBA has started cutting rates. So so that interest in the carry trade isn't as strong anymore. Okay, so so the carry trades continue because the differentials have remained wide. But meanwhile, the stock market has attracted a lot of investor interest. It's one of the best performing. So with the inflows keeping rates low as well, so we have seen HKMA intervening at the top side of the band. But at the end of the day, this does not mean that Hong Kong dollar peg is under pressure. Okay, so because because if it's so, then why would investors be rushing into the Hong Kong stock markets? So we will describe it as sharp swings from capital flows and carry trade dynamics, rather than structural weakness. Okay, and before I move on, I also like to highlight that because of the differential, we do think that when Fed is ready to cut, this could help dollar Hong Kong to move away from 7.85 back towards the mid or even below the midpoint over the next 12 months. Okay, I'm going to finish up with the Sing dollar. Okay, so our forecast is quite straightforward. This is the second time that dollar Sing has dropped below 130 again. It did that last year when the Fed cut 50 basis. But this time, we think that the fundamentals are there, and the world is becoming very clear with regard to Trump's policy, which contrasts very strongly with the way Singapore manages its economy and supports its AAA debt ratings. Okay. So, but nonetheless, in the event that the dollar, in the event that we get a loss in confidence in dollar, we cannot rule out dollar Sing heading to record low of 120. During which back then we have also seen, like today, record high oil prices. Okay, next week we may see the MAS. We may get the MAS policy review, and at this point, we think that they may wait and see, like the Fed, and maybe like the RBA as well. Okay, so the Sing is also quite strong. It's near record highs, despite two reduction in the policy band slope in January and April. Okay, so this reflects the Sing strength, and it's also quite high at 1.7% above the midpoint, according to our model, which we feel it should be closer to 1% or even lower, based on our lower official forecast. Okay, so to sum up, my presentation today is about taking stock, about the dollar's plunge in the first half of this year and how large it has been. And we think that a correction is due. But then history and the current policy environment in Trump 2.0 tells us to guard against complacency, and that we expect the dollar to resume its fall at a slower pace and maybe even extend into next year. Okay, so and bearing in mind that Trump, in the end, still thinks the dollar is still too high and U.S. interest rate is still too high, and obstacles to his market agenda to reshoring operation. And with that, I end my presentation. And again, if you have any questions, please go to the Pigeonhole. I will now look at some of the questions that have been posted in the Pigeonhole. And, okay, let me pick one. Okay, why don't I take a break and ask, I pass the question to Hunting. Okay, so I don't have the active button here. Okay, so there's a question about what's the view on the trajectory of China Plus One strategy amid, the evolving tariff developments. Yeah.
Thank you, Philip, and thank you for the question. I think this is a question that quite a lot of clients have asked over the course of this year with the evolving tariff developments. And I think we need to take a step back to think about how, what is China Plus One strategy and how this has evolved. So I think China Plus One strategy in simple terms is companies, other multinationals, or even Chinese companies diversifying away from China and into the plus one. And the plus one here is looking at Southeast Asia. And over the course of Trump 1.0, we have seen that Southeast Asia economies have benefited quite a lot from China plus one. And I think in this environment, there continues to be companies that want to diversify their supply chains and not rely on one location. And therefore, I think the China Plus One will continue to go on, especially as Southeast Asia continues to have some of the good factors such as lower production costs, growing workforce, ongoing improvements in the business environment. So I think the tariff developments are also, in fact, resulting in tariffs lower than China. So in terms of cost-wise, Southeast Asia is still an attractive proposition. So in terms of serving the US market, or in fact other markets that Southeast Asia countries may pursue.
Okay, thanks, Hunting. Okay, so maybe I'll take the next question. Which Asian currencies do we think will outperform in the second half? Well, I've already run through, I think, the first half performance. Interestingly, the Northeast Asian currencies like Korean won and the Japanese yen has done better than many of the Southeast Asian currencies. I think partly because of the pressure from the Trump administration's complaint about the weakness in their currencies. Then I've also, I think, more or less mentioned about that Southeast Asia currencies tends to be more conservative. But then again, I want to also bring to your attention that during Trump 1.0, most of us were quite worried about the tariff war between US and China because China depreciated their currency, its currency very strongly, resulting in being called a currency manipulator. Okay, so but this time around, I think it's a very different game, and as well as it's a very different way in which Trump is managing tariff, using it as a strategy to push for trade deals that are in U.S. favor. Okay, so I would say that I will still stick with the European currencies. I think in the next leg of the dollar weakness, and I will also, let's say for Southeast Asia, in terms of Fed cuts, I will still prefer ringgit and the Thai baht, and along with the Sing dollar. Okay, so with that, I think we've run out of time. Thank you very much for your time in this live stream. I wish you all the best for the second half of this year. Thank you.